Peter Orszag, let me start with you. And the basic question about whether or not tax revenue has to be part of this conversation to begin with, and whether the two sides, whether there's more common ground than they think.
Well, first, obviously, I think tax revenue has to be part of the solution here, both because of the underlying budget math, but also because of the election that was just held and the desire of at least the administration to obtain that additional revenue, which they ran on and won. On the substance, though, I mean, I guess the point I would make is whatever comes out of this fiscal cliff arrangement, frankly, I'm going to now step out of the bounds of political feasibility because I'm no longer in office, so I don't have to worry about those things, and say that the deal is very likely to lock in a revenue base that I think is inadequate for 2020. And so it's very important that we get to a deal and that it will include some revenue, but I just want to sort of lay down a marker that the revenue base that we're likely to be locking into makes the budget math for 2020 very challenging. And you see that because both sides are relying disproportionately on, I think, unrealistic out-year discretionary spending caps that in reality aren't going to work. And the reason they're doing that is the revenue base is inadequate and they have no way of getting to the specific spending reductions to hit their deficit targets. And so they plug the hole just by ratcheting down discretionary spending in a way that isn't actually that credible.
What is the more appropriate revenue target they should be shooting for?
If you look out at the 2020 type of horizon and you try to do the math on what you can do on the spending side, I think we need about 2% of GDP additional revenue compared to current policy. And interestingly, that would come if we just allowed all of the tax cuts, not just those above $250,000 in income, to expire. Not something that I think we should do immediately because of where the unemployment rate is, but over the next 5 or 10 years, we should be getting back to a revenue base that is consistent with the tax code of the 1990s, not consistent with what we're locking into today.
Dr. Feldstein, your thoughts on what Peter Orszag has just put forward?
We certainly need to have some revenue as part of this package. We need to tackle entitlements as part of the package. We're not going to get significant cuts out of the non-defense discretionary spending. But in terms of the revenue, I think the key is broadening the tax base, bringing down the tax expenditures. There's a lot of revenue to be had in doing that. I would say a plan that raised 1.5% of GDP without higher tax rates is certainly feasible.
And Donald Marron, let me get you to weigh in on this. What should be the target if the country really wants to get on a sustainable fiscal path? How much of the component should be tax revenue?
So, I mean, ultimately the target's got to be to stop the debt growing faster than the economy and have that eventually start coming down. Where you come out on that depends, obviously, on your beliefs about what spending ought to be, where it's likely to be. As you go out further, there are very large error bounds around estimates of what healthcare spending will be. It'll obviously be growing. I think Bowles, Simpson, and Domenici-Rivlin, both their plans came out with revenue levels that are higher in the long run than what the president is proposing at the moment, which suggests when you get people together and they think through these issues over a long time period, they think that a significant amount of revenue has to be on the table. And as Marty said, I think one of the best ways to go after revenue is to think about all of the tax preferences, the deductions, the exclusions, whatnot. A lot of those are really the moral equivalent of spending in the tax code, and they ought to be a place that there's an opportunity for bipartisan interest in rolling them back.
Well, Dr. Feldstein, you've written about this significantly. It was a big issue during the course of the campaign as well. Both the president and Mitt Romney, to some extent, have talked about this kind of approach. Let me ask you about that. Can you produce the revenue you need by, again, capping those deductions without, at the same time, raising overall marginal tax rates?
So if you stay with today's tax rates, no increase in rates, and you put an overall cap on tax expenditures, on deductions, on high-value employer-paid health insurance, on municipal bond interest. That's the base, and you put a cap equal to 2% of each individual's adjusted gross income of the benefit that they get from doing that. That produces about $150 billion at next year's annual rate. So $150 billion over 10 years, with the economy growing, is about $2 trillion. So you can raise a lot of revenue in doing that.
do that? And what about, again, Peter, let me get you to weigh in on that. Do you, first of all, subscribe to those numbers? And does that provide the middle ground solution here when the president says he wants to see higher tax rates? John Boehner says absolutely not. Is this the middle ground solution to look at capping deductions?
I think it's clearly going to be part of this solution, but just a note of caution. While it's desirable to be scaling back on those tax expenditures, it's a lot easier to say it at this kind of level of generality. It becomes a lot harder to actually enact it. The number of times when I was the head of the CBO, that Senator so-and-so would call me up and say, I want to talk about tax reform, and I'd walk in and he had his one talking point, which was broaden the base and lower the rate. And I'd say, okay, I get lowering the rate. Let's talk about broadening the base. Let's go item by item. What are you willing to scale back? Mortgage interest, can't touch that. State and local tax deductibility, can't touch that. Charitable, can't touch that. And you go down the list. One of the reasons why these new ideas are attractive, at least momentarily, is they are, to be blunt, obscuring a little bit what actually has to be cut back.
Don't they prevent the hard choices?
Yeah, there's still a hard choice there. It's just less
but there's
transparent.
also a sense of fairness in it, that we're not saying, well, we're going to cut out your ability to deduct your mortgage, but I'm going to get to keep my ability to deduct my local taxes. So everything goes into a pot. Everybody gets to keep their deductions, but they just can't be too greedy about it. They just have to limit the amount that they can benefit from it. Seems to me that's the selling point.
Yeah.
And Donald Marron, let me get you to weigh in on this, and also the notion here that can you do this and have it only affect the wealthiest Americans, not those, for the president's way of thinking, earning less than $250,000 a year?
Right, so that's an important point, right? So the numbers that Marty was quoting would be if you applied this to everybody. And frankly, there is a lot of money in these tax preferences for people who are below the targets that the president has set. And it seems like there's not a lot of willingness and enthusiasm in Washington at all for affecting those folks. So that's going to trim back the amount of money that's potentially on the table.
But this would, the 2% cap would, about half of the money would come from people above 250,000. The other half would come from the rest of the population. So it would produce about as much revenue from the top as going back to the pre-Bush tax rates for that group. But it would produce more revenue overall because it would cover the entire population.
It would violate the president's pledge, Peter Orszag.
Well, look, if you started to carve out those below 250,000, if you recognize that the nonprofit sector hasn't really woken up yet to what this will do to tax preferences for charitable contributions, and then you tried to carve out the charitable contributions to mitigate that impact, the revenue number will start to fall substantially, right? So again, my point is not that this is not a desirable thing to do, although within desirability, I think there actually are better ways of scaling back tax expenditures and moving towards credits. It's just, we're sort of at that moment. It's like that first moment in the meetings when I would go up to the Hill and it was happy talk about tax reform. It gets a lot harder as the true consequences become more apparent to the special interests.
So the president, I don't think has said, the president has repeatedly said high-income people have to contribute to solving this problem. I don't think he's actually used the language only high-income people have to contribute on the revenue side. I don't think he's ruled out, I hope he hasn't ruled out something which through base broadening would call for some contribution, proportionately less, but some contribution for people below the $250,000. Why should the guy who makes $100,000 make no contribution to this budget problem?
Donald Marron?
The president certainly ruled that out in his budget that he had this past year.
That's right. So but he hasn't in his current rhetoric where he says high-income people should contribute to solving the problem. He doesn't say the problem should be solved just by high-income taxpayers.
Donald Marron,
I hope that he can stay with that.
let me ask you about another component to this that hasn't been talked about as much, at least in the course of the conversation here today, capital gains and dividends. What about that side of it? Certainly the folks that watch Bloomberg and do a lot of investing, keenly interested in what happens to capital gains. If you move it up to 20%, or perhaps talk about an even higher figure than that, what would happen to the investment in this country, and how much money could you actually generate?
Right, so the first thing to know, first thing everyone ought to know, rates today are at 15% for capital gains and dividends. It is already baked in the cake that that's going to 18.8 for high-income taxpayers, and that's because of the tax increases that were included as part of 2010's health reform. So they're often overlooked in this discussion, but it's already a given that cap gains and dividends are going up. There's been this debate about whether to raise them further, right? Capital gains, for example, might go to 23.8. I think you're already seeing some evidence, and probably we'll see more as the year progresses, that sort of people are going to go out and sell stocks in order to lock in gains now, sell their private businesses. You're going to see a lot of timing games in the short run. In the long run, we're in a range where raising taxes on capital gains is going to contribute additional revenue, right? We're on the correct left side of the Laffer curve. It's something that is likely going to be part of the overall package for distributional and revenue reasons. Be my guess.
And is it a substantial sum of revenue? Are we talking, is it more political rhetoric? Is capital gains going to offer, a higher capital gains rate going to offer substantial revenue? Say it moves to 23.8.
So I forget the exact number. I mean, it's a chunk of money. Dividends is actually even somewhat bigger. And the two of them together is definitely a significant component of what the president's proposed on the revenue side.
In both of those cases, there's a very strong behavioral response to changing the tax rate. You don't have to realize capital gains. You postpone it. There's a question of what you do to capital gains at death. Right now, somebody who holds those capital gains till death, the tax liability goes away completely, so higher rates will induce more people to just hold on to whether it's a family business or stock that they bought at a low price.
The estate tax as well, the AMT, these are all part of the mix as well. Peter Orszag, how do they factor in here as bargaining chips, if you will, as negotiating pieces as this conversation begins?
Well, I think what you're identifying, capital gains, dividends, estate tax, these are one of the reasons why it will be not impossible, but it's challenging for this all to come together so quickly. And I want to just call out the final thing you said, which is the AMT. Don't forget, we do not have an AMT patch for 2012 yet. And the IRS commissioner has already said that without a deal by the end of the year and that covers that AMT patch for calendar year 2012, the IRS is not going to be able to process tax refunds until in early 2013 for the 2012 calendar year until perhaps mid-March. That means a lot of American households who go out and they do their Christmas shopping or holiday shopping in the expectation that they're going to get a quick refund early in the next year are going to either be caught out or they're not going to be doing as much shopping if they know this ahead of time. Just as one manifestation of the consequences of not having a deal in place by the end of the year.
The whole issue of taxing dividends and capital gains, the philosophy, the politics of that have changed dramatically over the last several decades. If you go back before President Reagan came to Washington, we had higher tax rates on the income from savings. And economists have been arguing forever that that's the wrong way to go, that it discourages saving, it discourages investment. And over time, those rates have come down to a point where they're lower. And I think it would be a mistake to go back in the direction of putting heavier burdens on savings and investment than we do today.
We haven't talked about the corporate rate at all, Donald Marron. What about the notion of both sides seem to agree on lowering the corporate rate, getting rid of deductions and loopholes there? That's just as heavy a lift, isn't it, politically?
It is. So it's exactly the same rhetoric and exactly the same politics that people talk about base broadening, rate lowering, tax reform. You saw in the recent presidential campaign, we had one candidate who was running on a 28% rate, one running on a 25% rate. You might think in Washington that means we're going to end up at 26.5%. Until you try to figure out how to pay for it. And again, the politicians will talk about rolling back loopholes, but when you actually look at them, there are a few loopholes out there, but really they're fundamental tax policy decisions that have been made about depreciation, about manufacturing, about the energy industry, all of which have significant constituencies behind them and all of which are difficult to address.
And of course, we haven't had a whole lot of folks, at least that I've heard in the corporate community, have suggested anything other than revenue neutral corporate tax reform. Not that the corporate community is going to offer much in terms of new revenue?
Part of the president's answer to that, and Peter can no doubt say much more about it, is to not make the distinction between the corporate and the unincorporated business part, and raise taxes on what one of the speakers earlier today described as pass-through entities, so large partnerships, things that might otherwise have been corporations. But Peter, why don't you tell us what we should be worrying about?
Well, look, a couple comments. First, I think there is no doubt that the corporate income tax in particular is a rickety structure at this point that is in need of reform. And fundamentally, it's coming about because we're in a world in which capital is increasingly mobile, but we've got this boundary around the corporate income tax that's based on a national boundary, and there's just tension contained in that phenomenon. But there's just dramatically different perspectives, to Donald's point, about where to move. The Republican Party seems much more interested in a territorial system where you're taxed just on the profits that accrue within the United States. The Democrats are worried that that creates even larger incentives for transfer pricing and for locating your profits overseas and thereby escaping that tax, and that's a fundamental divide. Now, in addition to that, what Marty was suggesting is also in play because a larger share of total activity has been, of business activity, has been occurring in non-corporate settings. That is, businesses that are not subject to that are not C corporations and are not subject to the corporate income tax. And that's actually where you also get into other related issues, including the carried interest debate, because a lot of that, a lot of those funds are flowing through structures that are not C corporations. And that is also going to be, one of the subsidiary issues that are in play in this tax debate, undoubtedly.
If you raise the corporate rate, if you lower the corporate rate to 28%, as the president suggests, and you raise the personal rate to almost 40%, you create an incentive to go back to what people did before and to figure out how to incorporate all their activities and get the lower rate.
Have you heard a good idea on the table about how you can ring fence true small business people, or if that's even something that should even be pursued? I've heard Republicans say, listen, I might be willing to go further on revenue if you can guarantee me that the small manufacturer down the street in my district isn't going to get hit hard with that higher tax rate.
You mean somebody who's already a corporation? Or
somebody who's not a corporation.
Non-corporate.
A small business
argument. You would, whatever rules there would be for forcing pass-through entities to become C corporations, you would put a size factor in it. So if you're less than so much in revenue a year, you're not required to do it. But if you're a very, very large pass-through entity, then you may be forced to file as a C corporation.
Donald Marron, walk me through the pitfalls of that. And I can only imagine the lobbying and the companies that, or the businesses that choose to stay below that line and debate whether they should go above it.
I mean, it's always problematic when you have arbitrary thresholds in anything, right? And so on a blackboard, at least, the optimal way to deal with this is to have the tax system be neutral across organizational structures. Set up your tax system so you collect enough revenue, but not have it drive how you organize your behavior, whether you have 49 employees or 50. The small business discussion is, so a lot of tax policy discussions have a relatively low ratio of content to rhetoric. The small business one is one that's particularly bad on that ratio.
Separate fact from fiction for us.
Well, so first of all, hi, I'm a small business. Right, so I LLC'd myself for the small amount of consulting I do on the side, but I don't feel like that makes me a small business guy. I have a day job at the Urban Institute. The data that you get, are such that you read a lot of people like that or who have a second home that they rent out as though they're small business people. And so when you want to think about this for real, you have to strip them out. There are real businesses, though, that have their taxes paid on personal income taxes, and you need to think about that carefully. That is a real effect. Most of the activity is in the corporate side is multinationals, and really you get back to the issues that Peter was raising, that really a lot of the attention at that level is really about this issue about territoriality versus worldwide taxation, some about the rate.
The surprising thing about this territorial question, about whether we should tax American companies' overseas profits when they bring them back as if they had been earned in the United States, but give them a credit for what they have paid in taxes abroad. we're the only OECD country that does that. The other major industrial countries around the world all say that what you earn abroad, if you want to bring it back into your country, you pay a small tax, maybe 5% or something like that, and you can bring it back. Now, the argument that somehow that's going to lead jobs to go someplace else ought to be as relevant in those countries as it would be in the United States. But 27 other OECD countries have figured out how to live with that. So I don't know why they're so much smarter than we are that we couldn't prevent that from happening.
Peter Orszag, you want to walk me through? The Obama administration has been adamant about this. This is just going to lead to stock buybacks. It's not going to be productive for the economy. That's one of the arguments.
Well, there are a couple different components to it. Apart from the employment dynamic, I think the larger concern is transfer pricing and just simply artificially manipulating where the profits are occurring in order to escape taxation.
The question is, why are we not better at catching
We have
that?
more global multinationals than anyone else, so the problem is a more germane one for us than for
France.
for France. For France. Now, I would note, states within the United States have faced exactly this problem for a long period of time. They all have individual corporate income taxes. Corporations can move their profits across different state lines. And so each state is the equivalent of the problem that we're facing on a global basis. The way they have attempted to deal with that, and it's sort of kind of worked, is to take the things that are the hardest to manipulate, things like sales. It's much easier to manipulate where your profits occur than where your sales occur. And say if a formulary apportionment system, which on a national/global basis would run something like, if X% of your global sales are in the United States, and that's hard to manipulate, then X% of your global profits are taxed in the United States, period. Doesn't matter how you do your internal accounting. It doesn't matter whether the funds come back or not, this, that, or the other thing. 10% of your global sales are in the United States. 10% of your global profits are taxed in the United States, period.
What, Martin Feldstein, Donald Marron, what's wrong with that idea?
I'd have to look at the arithmetic. I'd have to see how it actually
Always gets back to the numbers, doesn't it?
But I mean, certainly what we're doing now flies in the face of what every other country does, and it provides very strong. I mean, American corporations probably have something close to $2 trillion abroad in funds that they don't want to bring back. And they will instead find ways of buying companies abroad or opening new plants abroad because the penalty for bringing it back is often high. Now, if our corporate rate comes down, that penalty will be less. But even so, it can be high, and we want to somehow get around that so that they feel free to bring it back.
Donald Marron, what's your take on that issue, the territoriality issue, and is there indeed a windfall coming back to the United States? How much of a lift for the U.S. economy could this mean? We certainly have had a lot of business folks come on Bloomberg and tell us, listen, we're going to put this money right to use back in the U.S. if you drop this rate, if we can repatriate this money.
Right, so we tried an experiment on that back in, I forget, 2004, 2005 on a temporary basis, temporary repatriation, and the economic studies I've seen all suggest that it had little to no impact on observable economic outcomes. And so to the extent that folks are still talking about possibly doing that on a temporary basis, I would suggest the evidence is that it would not have a big effect. The more interesting question is in the long run whether it would have a substantial effect in corporate behavior. There, I think the arguments are, I think, somewhat stronger. Certainly the world has changed over the last few decades as competition has grown abroad and as our tax system has become increasingly out of whack. Right, we now have the highest corporate tax rate in the developed world. As Marty was saying, the structure of our system is different from most of our competitors. And I think there's a good argument you can make that trying to be more like the norm of our major competitors would put us in a better competitive situation.
We have just about 3 minutes left here. I want to get all of your takes on some ideas that have been put into the mix that are sort of outside the box. And given that this is a full reassessment of the American tax code that we're told is about to take place, a carbon tax, consumption tax, other ideas outside the box that you all think should be part of the conversation, whether or not you actually support their inclusion right now. And Peter, I'll get you to start with you on the idea of a consumption tax.
Sure. Well, I think actually both a consumption tax and a carbon tax have desirable features. It's just they're not even remotely likely to happen over the over the next 12, 24, 36 months. I mean, to start with a carbon tax in particular, unless you're going to completely deny the probability that we will face increasing risk from carbon emissions, pricing carbon strikes me as an absolutely essential step in order to get the behavioral change and the technological innovation that we will need in order to ultimately adjust and adapt to what we've already done. A carbon tax also raises revenue in a way that could be used in a variety of different forms, but it has an additional kind of benefit associated with it. So I'm all in favor of it. I just don't think it's remotely plausible within the narrow political discussion that we're having today.
Dr. Feldstein?
When we start seeing gasoline prices coming down because the price of oil starts to fall because of all of the activity and producing in this country, maybe that'll be an opportunity to increase the federal gasoline tax. Even if we don't go to a full carbon tax, it could produce a lot of revenue with 50 cents a gallon of federal tax.
The only problem is from a climate perspective, transportation and gasoline/petroleum is a small share of the problem. The problem is really in the energy sector, and without a carbon tax, you're not really directly getting at that. But
Donald Marron?
So I think for the reasons that have been described, I think a carbon tax makes enormous sense to deal with the environmental impacts of energy use. I think you can design one in such a way that it doesn't cause too much harm for American industries that compete with folks abroad who are also in polluting industries. Consumption tax, very heavy lift if you try to do a value-added tax or something directly. There are things you can do to tweak the income tax, though, to make it look more like a consumption tax that ought to be part of the discussion.
Let me just wrap up quickly. I want each of you to go down the line and give me your thought. At the end of the day, what do you think the tax code is going to look like when these conversations between the President and the Speaker Boehner are done? Is it going to be, give you just that quick snapshot, what is it going to look like when they're done?
I think we will have slightly higher marginal tax rates on some high-income tax, at least one high-income taxpayer. And I think that there will be a variety of tax exclusions and deductions that are scaled back modestly. And that's about it.
If scaled back means capped in some way, I think I agree completely with what Peter said.
Donald?
I think we'll see some of those things rolled back. I think the top rate will neither be 39.6 nor 35. It'll be somewhere in between. And I would guess that dividends end up at the same rate as capital gains rather than higher.
All right. We have some common ground here among our economists as to where we're going to end up at the end of the day. Thank you, gentlemen, for joining us.